Hey, and welcome to the Property Investors Podcast. My name is Russell Leeds, and this week I'm going to be comparing two of the most exciting investing strategies, two things that I personally invest in myself, and we're going to be looking at the pros and cons and working out which one is right for you, because they're both really good. However, by the end, in my opinion, one of them is a clear winner. So let's jump straight in. We'll start off with the S&P 500. So for those of you that aren't familiar with it, the S&P 500 is part of the stock market. And I want you to think of the S&P like a big team. So imagine like a giant sports team made up of 500 players. And these players are like the best companies in the United States or probably the world. You know, we're talking players like Apple, Google, Amazon, all the big companies. These are the people that make up the S&P 500. And what you're doing is you're buying a very small piece of all 500 companies. So if they perform well and they go up in value, you get paid. If they pay out dividends to their shareholders, you get paid. So you're kind of backing very, very much a winning horse with the S&P 500. This is good for several reasons. First of all, it's very much safety in numbers. If you buy stock in one company, if you bought, just stock in Apple, and then something went wrong, like imagine if you'd bought Blockbuster back in the day. If you bought stock in Blockbuster and then Netflix come along, you could pretty much lose all your money. The thing about a company is it can literally, the value can drop to nothing, right? So you could lose absolutely everything. With the S&P 500, you're spreading that risk amongst 500 of the best performing companies in the world, certainly in America, but you're spreading the risk amongst all of those companies. And the thing is, they update it on a regular basis. If there's a company that's not performing very well and it drops out, another better performing company will pop in and take its place. So you don't have to do anything. It just happens in the background. You invest your money into it and it all just ticks along very nicely. Now, there are ups and downs. So me personally, if I'm investing in the stocks and shares market, I don't want to be a trader. I don't want to be trying to buy stuff and then when it goes up the next day, selling it. And for me, if I'm investing in stocks and shares, I just want to be investing in something safe. I can just put my money into it and let it passively go up in value over time. And if it drops a little bit, that's okay. Maybe buy some more because that's the time to buy when it drops. So if it drops a little bit, that's okay. Wait for it to go back up again. And historically, the S&P 500 does go up over time. So that's what it is. Let's have a look at some of the pros to the S&P 500. So the first pro, massive pro, really good pro, is it's very liquid. So the S&P 500, you can invest, but you can also get your money back as cold, hard cash very quickly, very easily if you want to. This is a massive pro, right? Because it means that if you do need to invest in anything, you can. You can't become sort of over-leveraged where, you know, a lot of people that go bust, they've got assets, but they just can't get the money out of them and they need the cash. That won't happen to you in the S&P 500. Now, it can be a bad thing as well. There is something to be said about investments where you can't get your money back very easily because you can't be tempted to take the money out to go on holiday. The S&P 500, you literally could do that. You go, you know what? I fancy a holiday. Let's have a look at our account. Trading 212. Let's just sell those shares and go on holiday. Now, obviously, that would be stupid, but a lot of people would do things like that. So it being liquid is a pro because you can get it if you need it. It's also a bit of a negative because you could spend it on stupid, dumb stuff very easily. Whereas in property, for example, we're going to talk about later, it's a lot more faff to get your money out. So, but I think overall, that is a pro. So very, very liquid. Next pro, massive pro, great pro, is you can start very small. I think the minimum deposits on some sites is like £1. So if you've got £1, you could invest. And this is actually one of the reasons why I got into the S&P 500 is I was looking for something for my kids to invest in. I want to encourage my kids, they're now aged 8 and 10, I want to encourage them to invest, and we give them pocket money and we say to them, here's your pocket money, but guess what? You've got to invest at least half of it. You can invest more, but at least half of it into the S&P 500. So I'm getting them in the habit of when they have money, investing it. And I can't just say, oh, here's your pocket money, go and buy a house with it, right? Because it's like, oh, I've got a fiver here, not going to get me very far, right? So the S&P 500, another really big pro is you can start really small and get in the habit of investing, which I think is great. Number 3, another big pro, a lot of pros for the S&P 500. Number 3, historic performance. Historically, it has produced very high, strong returns, often outperforming experts in the stocks and shares case. And, in fact, most people that you pay to manage your portfolio can't put together options as good as the S&P 500. And typically, you're looking at about 10% return on your money a year, which for something that's completely passive, I think is very solid. Which brings us, kind of mentioned it there, brings us on to number 4. It really is passive. Now, I often have a debate with people about passive income. What is the definition of passive income? Is it money where you literally do nothing? You can just sleep and you're earning money all the time? Yeah, kind of. But the dictionary definition actually says money that you earn with little to no work. Okay, so it could be a little bit of work. If you own a property, for example, is it a little bit of work? Yeah, it's a little bit of work. Yeah, you might get a tenant phone you up, but pretty much you're not doing anything. You've got the money coming in. The S&P 500 it's like doing a bank transfer. You just transfer the money from your bank, and that's it. That's your part done. If you can transfer money, if you know how to open an app on your phone, that's about the level of the amount of work you're going to have to put into this. So from a passive income point of view, it is about as passive as you are going to get. It's super, super hands off, not doing anything. All you've got to do is reinvest the funds. That's all. It's like, that is it, right? So anyone can do this. Very, very easy. No issues at all. Number 5, benefit for the S&P 500. Not only is it passive, it also can be tax-free. Now, how can you invest tax-free? Well, if you use something called a stocks and shares ISA, now this is for UK-based investors. There might be similar setups in other countries, but I can only speak from my experience, which is here in the UK. At the moment, you can invest up to £20,000 a year, where anything you earn on that £20,000, any dividends, any capital gains, it's all tax-free, right? Now, that's brilliant because it means you can invest £20,000 a year, which is more than most people that make use of this stocks and shares ISA don't invest as much as the £20,000. That's quite a lot for a normal person to invest. So you can invest £20,000. If there's a couple, you can invest £20,000 each. So £40,000 you're investing in. And every year you can invest another 20, another 20, another 20. You could build up a nice portfolio that was paying you tax-free money. So if you're just investing little bits and pieces and you don't want to worry about the tax, invest it for a stocks and shares ISA, and it is completely tax-free. So overall, I think the S&P 500 is a brilliant little investment for all the reasons that I've just mentioned. Now, let's have a look at my other favorite type of investment, which is real estate, UK property market. So we all know what that is. I don't have to explain that. Let's have a look at some of the pros. Number 1, big pro, it's actually a tangible asset. So I always think when you're investing in something, it's nice to actually own something, right? If the American market absolutely fell apart, and we have seen things like this happen in the past where just the value of the companies are just gone, I don't think that would happen to property. Sure, the values could severely drop, right? But you're not going to have a property or a piece of land that's worth nothing because people still want to live there, right? It doesn't matter how bad we go as a nation. I can't see living in houses going out of fashion. So you've got this tangible asset, you've got this land. It's something nice about having a tangible asset so that you actually own. You can drive up to it. Hey kids, we own that house. Hey kids, that one as well. Hey, see that commercial building over there? We own that. There's something nice about that. So I would say that is a pro. It also means that it can't drop to nothing because it's tangible. It's an asset. It's not just on paper. That's the first thing. Right, number 2, and this is a big one. This is one of the winning pros for property investment, and that is the use of leverage. Leverage is massive in the property game, and the main use of leverage is a mortgage. So if you want to buy a property, say a £200,000 property, and you want to buy it, you don't have to have £200,000 to own the £200,000 asset because you can get a mortgage. Now, if you're doing buy-to-let investing, which probably most of you are because you're a property investor, not just an owner, you can get a mortgage typically of 75%. So that £200,000 asset, you don't have to put in the £200,000. The mortgage company will lend you 150. You only have to put in £50,000, which is great, brilliant. And another massive benefit of a mortgage is that you can kind of get tax-free earnings. I say kind of because obviously you'll still pay tax on the rental income, but you can pay no tax on the uplift in the property if you leverage mortgage. Let me explain how this might work. I'll give you an example. Let's say we go back to that property we just talked about. Let's say you bought a property for £200,000. And you got a £150,000 mortgage and paid £50,000 for the property yourself. So you're 50 grand in, but you own a £200,000 asset. Now, in 10 years' time, if it's an interest-only mortgage, how much will your mortgage be? Well, it will still be £150,000 because you're only paying off the interest. How much will the property be? Well, we don't know, because it's in 10 years' time. Who knows? However, we can only look back at history because we know history tends to repeat itself for signs and clues of what's going to happen in the future. And if we look back 90 to 100 years, which is about as far back as you can go, every 10 years, property prices have only gone one way, which is up. And in fact, they've actually more than doubled on average. And I've done a podcast on this where we've looked at every 10 years, and it doesn't double every 10. It might be that I think in 1930s they were worth £400, and in 1940s it was 600. Aha! It didn't double. But then in the 1950s it was 1,600. So it more than doubled in that decade. And over time, on average, they more than doubled. So let's say in 10 years' time, our £200,000 house is now worth £400,000, and it is doubled in value. You've still got a £150,000 mortgage, and your property's doubled in price. But how much has your money gone up? Has your money also doubled in price like the property? Well, no, because you only put in £50,000. You've still got a £150,000 mortgage. The property is now worth $450, which means that your equity, the amount of money that you've got sitting in the property, is now £250,000. So in 10 years, your 50 grand has times by 5x up to £250,000. So what would you typically do in that situation? Well, you could sell it. If you sold it, you'd have made a profit of £200,000, and you would either pay capital gains tax, which is normally about 24%, or corporation tax, which right now, annoyingly, has gone up to 25%. You should be paying around about 48, maybe 50 grand in tax, which would mean that you made 200 grand, pay 50 grand in tax. You'd actually be left with 200 grand in your bank because you put 50 grand in the first place, right? So you paid 50 grand tax, made a profit of 200 grand, 150 grand, basically, you're left with. However, if you got a new mortgage on it, they would lend against the £400,000 value. So they would give you 75% of the £400,000 value, which is £300,000. Now, that would need to pay off your previous mortgage of 150. So they would give you cash in your hand, 150 grand. So you'd be left with 150 grand cash, but you'd still own the property, which had £100,000 of equity in, and you'd pay no tax because you don't pay tax on debt. And the money that they've given you is the mortgage money, it's the debt. You don't pay tax on that. So you can invest in property, let your properties go up in value, refinance, and get paid very handsomely and continue to own the property, which is amazing. So I think that you can invest in property and get a lot of your money out tax-free, which is even better because we're talking much bigger figures than the S&P 500, but both of them are really good. Number 4 is rental income. So I suppose similarly to dividends, with the S&P 500, you get paid in dividends, but it's not very much, about 1%. You can get paid rental income through your property, which can give you a great cash flow. And if you know cool strategies like social housing or service accommodation or HMOs, you can get really good positive cash flow from your rental portfolio that would way outperform the S&P 500. Number 5, they historically go up over time. We touched on that earlier, doubling every 10 years. So they're the pros to property investing. Now, it does come with some cons. Okay, there are 3 cons that the S&P 500 have over the property market. Number 1 is it's not very liquid. In fact, it's the exact opposite of the S&P 500. So it's difficult to get your money out. And it can cost you a lot of money. If you sell it, it can take time to refinance it. Getting your money out is difficult. It's definitely very illiquid. Okay, so if you're highly leveraged and then suddenly you need money, that could be a problem. You could lose your property, you could be forced to sell it at a lower amount. That's the one time where you can lose money in property, if you're forced to sell. If you just wait, it will go up. Even if you buy a crappy property, really bad property, time is on your side, because we know over time it's going to go up in value, it will bail you out. If you're forced to sell, you can lose money in property. So that's the first problem. Number 2, they're pretty high initial costs. Again, totally the opposite of the S&P 500, where you can invest £1. Property, if you're actually buying property, you're going to need some money up front. You're going to need money for a deposit. You're going to need legal fees. You're going to need stamp duty, which is a right nightmare. And even maintenance costs, running costs, it can cost a lot more. And number 3, it's not as passive. It can be passive, but there is still work needed. It's nowhere near as passive as the S&P 500. And if you get management companies, everything in place, that takes away some of your profit. So it's definitely much more hard work. Now, 3 years ago, I started investing in the S&P 500, and I also bought a property. So what I thought I'd do now is compare the two 3 years on, and I could run through the figures with you and show you how they performed, and then you can decide which you think would be best for you and what sort of deal you would like to invest in. So we'll start off our property deal. So I bought a property in Birmingham, and the figures were I bought it for £235,000. Now I needed a deposit of 59 grand, legals, couple of grand, stamp duty, 7 grand, plus a light refurb. I ended up, all in all, I put in about £70,000 to buy the property. 3 years later, which is now, I just had it valued, and it's gone from 235 to, drumroll, £290,000. So very pleased to say I've made £55,000 in capital appreciation, which is great. Now, it is illiquid. I'm still in a fixed mortgage term, because I fixed for 5 years. I'm still in a fixed mortgage term at the moment, so I can't really access that money without paying penalties, which is one of the cons we talked about earlier, but I still have it, 55 grand. Happy days. Now, I'm renting it out as a serviced accommodation, which is Airbnb, Booking.com, etc. So profit on that, I'm actually turning over around about 30 grand a year, but forget the turnover, let's look at the profit. So year 1, I made £13,459 in profit. Year 2, I made £14,059. And year 3, I made £13,809 in profits. That's how much profit I'm making renting it out on Airbnb, Booking.com and everything. That's after the mortgage payments, any maintenance, the cleaning fees, the fees to Airbnb and Booking.com. That's just money that's come to me, which is a total rental profit of just over £41,000. So that means if I add the 41 plus the 55, I've made just over £96,000 of profit in 3 years since owning that property, which is £32,000 a year, just over, and an ROI of about 46%. So I'm very happy with that. It's a really good deal. Very happy to share the figures with you. Now, I also invested at the same time into the S&P 500. Now, I actually didn't invest 70k. I invested less because I was doing the stocks and shares ISA, so keeping under the 20 grand. But I've gone onto a calculator and I've changed the figures to 70 grand so that it's like for like. So you can see exactly the same. So if you invested £70,000 in the S&P 500 3 years ago, and you had the choice at that time, you got 70 grand sitting in the bank, should I buy the property? Should I invest it in the S&P 500? Both really good investments. What should I do? So if you invested it, you would now have that £70,000 would be worth £92,046.82, which is a profit of £22,046, which is about £3,348 a year, and an ROI of around about 10%. So on paper, you look at it and you go, well, you're definitely going to make a lot more with property, right? It just makes sense to invest in the property. And I would definitely do that. 95% of what I invest in is property. We've recently buying hotels. I think service accommodation is a fantastic model to get really high cash flow. I love the high cash flow. I love the capital appreciation that you get as well. I love the leverage. I love the way you can use a mortgage to buy assets that are worth a lot more. As soon as my fixed term on this finishes, I will definitely be refinancing it and then using that money I pull out to do it again and to go and buy another one. So for me, property is the way to go. However, I do think it depends on your personal situation. You know, if you've only got $5,000 in the bank, and you want to invest that, you obviously can't go and buy a property. Now, probably my next favorite strategy would be to go and do something like a rent-to-rent deal. You could put that money into renting a property, do exactly what I've done with this property that I happen to own, rent it out as service accommodation and benefit from the cash flow. But that's more work, right? You've got to go and find a deal. You've got to learn how to do it. Yes, you're going to make a lot more cash flow, but if you're working 60 hours a week, I don't know your situation. If you're working 60 hours a week and you've got no time, zero headspace for any of that, the S&P 500 is a really good bet. The other thing is, why not do both, right? Put the money in the S&P 500. Remember, one of the benefits is it's really liquid while you're going out there looking for a property. Let your cash go up, let your deposit rise, and then when you find a property, bang, take the money out and go and buy it. So you could definitely do both. But there are pros and cons to both. In my opinion, property is definitely the way to go. But I don't think there's anything wrong with a little bit of diversifying your portfolio. And I, like I mentioned before, personally do invest in the S&P 500. I'm definitely a both type of guy rather than, you could either do this or this. If they both work, right, do both. So I personally think do both. But my focus and my energy is definitely in property. I think that is 100% the best investment. But I'd love to know your thoughts. Which do you think works better for you in your situation? Or what are your experiences investing in both? It might be that you've invested in property and had a terrible experience. If so, let me know. I'd love to hear what you guys are doing right now. Comment below. I hope you enjoyed this week's show. I'm Russell Leeds, and I will see you next week.